Okay, good morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Veron. It's my pleasure on behalf of the Peterson Institute to introduce this new session of the financial statement series at the Institute. And today we'll once again discuss China and what's happening in China and how to assess the risks with a number of stresses. For this, I cannot think of a better analyst and observers and Tom Orlik. He's the chief economist of Bloomberg LP, head of Bloomberg Economic Research, and has spent a number of years in China, has very much on-the-ground experience. Even so, he moved back to the US 4 years ago. Tom trained initially in English literature at the University College London, where he got his BA in 1999. He then completed his training later on at the Harvard Kennedy School with a Master of Public Policy in 2005, and then at the Jiaotong University in Shanghai. He worked initially in public policy at the UK Treasury, also on secondment at the IMF and the European Commission, so that was between 2000 and 2007. And then he moved to China. He was a consultant at Stone and McCarthy for 2 years in Beijing. Then he joined the Wall Street Journal, where he was a China economics correspondent until 2013. And then he joined Bloomberg as chief Asia economist. He became the chief economist of Bloomberg in April 2018. As I said, that's when he moved back to Washington, D.C. And he, in 2020, he published at Oxford University Press a book titled China as a Bubble That Never Pops, which I guess has it in the title and maybe a teaser for what he will tell us today. With him today is my Peterson Institute colleague, Tianlei Huang. Tianlei trained in Shanghai, where he grew up. He got his BA in international politics from Fudan University in 2015. He then worked in a private sector think tank in Shanghai. And then he moved to the US. He studied at SAIS Johns Hopkins, where he got a master's in international economics with a specialization in Southeastern Asia studies. Tianlei is proficient in Burmese, among a number of other languages. That was 2018. And it's also a dual degree with Tsinghua University in Beijing in political science. Tianlei then worked in a number of think tanks, the World Resources Institute, the Hudson Institute, and Brookings before finding his true place at the Peterson Institute in 2019. And a year later, in 2020, he became a research fellow. And we have worked together on a number of China-related projects. So I cannot claim entire neutrality while moderating a discussion with Tianlei, but I will do my best. And with that, Tom, over to you.
Well, thanks very much, Nicola. Great to be here. Real pleasure to participate in your financial statement series at Peterson, and very much looking forward to the discussion with you and Tianlei. I should also say congratulations to both of you on your recent paper on the evolution of the private sector in China, which clearly is grounded in some extremely detailed research and with some thought-provoking conclusions. Let me attempt to share my screen. 1 second. Now, how are we doing? Is that sharing correctly? It is. Okay, great. So what I'm going to do is share some thoughts on how China's governance system, financial system, and international standing has fared during the COVID stress test. And then I'm going to try and use that understanding to inform a view on China's future growth trajectory. And as we're sitting here in the capital of the United States, I'm also going to apply that to some thinking about the US-China economic race. So it's actually quite a lot of territory. I'm going to try and trip over some fairly deep and complicated subjects quite quickly. There's going to be a lot left for us to discuss. So first of all, COVID has been a stress test for governance systems. Now, measured on their own authoritarian terms, I think we can say that China's system has stood up fairly well. China's policymakers have mobilized the state sector, the private sector, the social sector. They've taken some fairly extreme and draconian measures, which I don't think we would have welcomed or tolerated here in the US or in Europe, but they have succeeded again in containing the virus with a very, very limited public health cost, certainly compared to the very high number of fatalities which we've sadly suffered here in the US and in Europe. At the same time, I think the experience of China's governance in the COVID stress test also raises some concerns about the future. In particular, let's think about the question of leadership succession. Now, Deng Xiaoping is rightly celebrated as China's great economic reformer, but he was also a reformer of China's governance system. In particular, he instituted the two-term rule. And that was a rule which was observed by Jiang Zemin and by Hu Jintao, but very likely it won't be observed by Xi Jinping, who appears set to take a third term, and who knows, perhaps after that, a fourth term as China's paramount leader. That raises some concerns. If we think about countries around the world which have had leaders in place for a very long time, Robert Mugabe in Zimbabwe, Erdogan in Turkey, Putin in Russia, China, of course, under Chairman Mao, what we saw was a progressive deterioration in the quality of advice that the leader received, and so a progressive deterioration in the quality of decisions and the quality of overall governance. Is that going to happen in China? Well, of course, it's too early to say. But when we think about the debate going on right now on COVID-0 in China, I think there's a sort of a worrying indication. No matter who you ask about when COVID-0 is going to come to an end, you get the same answer. It can't change until Xi Jinping has secured a third term as president. And for me, that already raises the question about whether this most important question, when China can exit COVID-0, learn to live with the virus, rejoin the rest of the world, reopen its economy, it raises the question of whether, the question of whether that important issue is being settled entirely in the national interest, or perhaps according to some narrower political calculus. Now, COVID has also been a test of China's financial system. So there's a kind of a pessimistic view on China's financial system, which is pretty prevalent here in DC and on Wall Street. And the idea is really captured in this chart, which shows credit as a share of GDP. And what you can see is that credit as a share of GDP has rocketed up over the last 14 years, from about 140% in 2008, before the Great Financial Crisis, to about 280% today. And if we look around the world and we scan the history books, other countries which have experienced a similar massive increase in the credit to GDP ratio have often experienced a financial crisis. So perhaps the same thing could happen in China. Well, COVID was a kind of test of the resilience of China's financial sector. There was a moment at the start of 2020 and another moment today where a lot of the biggest borrowers, the local government financing vehicles, the state-owned enterprises, the real estate developers, they closed down. They didn't have any income, so they couldn't repay their debts. So that was a moment where if China's financial system was really teetering on the brink, it could have toppled over. We could have had a financial crisis. And of course we didn't. And to me, that speaks to the kind of hidden resources for resilience in China's financial sector. And in particular, when I think about the resilience of China's financial sector, I think about the very, very stable and abundant funding base for the banks, grounded in the savings of China's households, which remain very high and which they have difficulty taking offshore. And as long as China's banks have that stable funding base, even as their loan book continues to grow, even as their bad loans continue to grow, the trigger for crisis just isn't there. Now, COVID hasn't been the only problem for China's financial sector in the last 2 years. So I want to also think briefly about what's happening in the real estate sector. So this is a picture that I took on a trip to Ordos in Inner Mongolia, on a trip there a few years ago. And it's one of one of China's famous ghost towns, huge developments of empty property, kind of emblematic of a real estate sector which is overbuilt and over-leveraged. Now, China's policymakers have recognized that the real estate sector was not on a sustainable trajectory, and they've taken some fairly decisive measures to try and rein in the excesses in the sector, in particular, cutting down on developers' access to finance. In doing so, they've pushed some developers to the brink and allowed some of them, notably Evergrande, one of China's biggest property developers, to topple over into default. Now, my view is that actually this is the sensible path for China to take. If they want to move the economy and financial system onto a sustainable path, they need to rein in real estate. They need, in particular, to remove the problem of moral hazard from lending to real estate. But in doing so, of course, they risk catalyzing the crisis that they're attempting to avoid. So far, we've seen a number of defaults. We haven't seen anything which looks like a systemic financial crisis. Why is that? Well, our discussions with officials at state banks suggest that they're under pretty clear instructions from the regulators. Don't continue growing your real estate loan book, but don't engage in a fire sale of your real estate assets either. Don't engage in a fire sale of your bonds. Don't engage in a fire sale of your loans to real estate developers. And so even as we see stability, essentially, in the financing for the real estate sector right now, I think we should keep in mind that it's in a sense a kind of fragile and artificial stability with some big problems still to be dealt with. Now, COVID has also been a test of China's international standing. And here, the story for China is really not especially favorable. I'm sure many of you have seen this Pew survey, which shows unfavorable views of China climbing sharply higher in the last few years. In the US, of course, that's no surprise, but also in many European and Asian countries. And there are some reasons for this. The world does not like what they see in Xinjiang. They don't like what they see in Hong Kong. They don't like the opacity around the origins of the COVID crisis. And this sharp increase in disapproving or unfavorable views of China is a problem for China for a couple of reasons. China is a big exporter, so having bad relations with export partners is really not good news. And China is also a net taker or a net learner from global technology. It's absorbing ideas and technologies from global universities, businesses, which accelerated and continues to accelerate China's growth trajectory. So if the world becomes more hostile and those technology links start to break down, it's easy to imagine China moving onto a slower path in terms of its productivity growth. So some risks around governance, some signs of stability, but also some big problems to deal with for the financial sector, and some concerns about China's relations, China's fragmenting relations with the rest of the world. Let me try and wrap that all together very briefly into a forward look at China's development trajectory. So this is a chart that we at Bloomberg Economics made a little while back. And what it shows you is China's GDP as a share of US GDP under different scenarios for China's future growth. At the top, you've got a scenario where everything goes right for China, where they execute on reform perfectly, where their international ties stay strong, where they can deleverage without hammering growth. And if that happens, they overtake the US pretty quickly and accelerate into the distance. At the bottom, in the yellow line and the pink line, you've got scenarios where China's been making up its data, actually quite a plausible scenario, and is already on a much slower growth path than the National Bureau of Statistics acknowledge, and a scenario of financial crisis, where China has something like a Lehman moment and goes into recession and never really comes back as strongly. The two lines I want to focus on are the white line and the red line. So the white line, I think, is where many people had their base case a couple of years ago. And it was a scenario of partial reform success, some fraying of international ties, but certainly not a new Cold War, and some cost from deleveraging, but not a financial crisis. And that plausible base case saw China overtaking the US in around 2032, and then pulling ahead into a decisive lead. The red line is a scenario of reform failure, substantial, if not complete, international isolation.
Sorry for interrupting, you meant 2032, right?
I heard what did I say?
I heard 22, but maybe I missed it.
Okay, yeah, I may have misspoken, but thank you. Yes, it would be 2032. Unless we're measuring in PPP terms, in which case they've already overtaken. So then the red line is a scenario of partial or substantial reform failure, of substantial, if not complete, international isolation, and of significant stress in managing down bad loans in the financial sector. Where are we today? Well, I'm not going to make a definitive call on this. I think we're still in the COVID crisis. We're still in the real estate crisis. It's really not a good moment to make definitive calls on the long-term trajectory. But given the concerns we have about the future path for China's governance and all that means for the reform agenda, given the concerns we have about the difficulty the financial sector still faces in managing down its bad loans to the real estate sector, and given the concerns about China's growing international isolation, I wonder if the base case is moving a little bit down from that white line towards that red line, and China's growth path is going to be slower, overtaking the United States is going to be further in the future, and the long term might see China and the United States more or less as having equal shares of the global economy. Let me end there, and very much looking forward to Tianlei's remarks and our discussion. And I'll end my slide share as well.
Thanks, Tom. That was superb. Tianlei?
Well, first of all, thank you very much, Nicola, for inviting me. It's a real pleasure to join you and Tom today. I saw Tom gave a very interesting and thought-provoking presentation that covers many grounds. And in some aspects, it was a strong pushback to some of the popular narratives about China in the West. I'd like to make 3 points in my remarks following up on that. The first point I would make is about the role of the state in the Chinese development model. We all know that the Chinese state plays a unique role in its economy. It owns land, it controls the financial system, and it owns a massive state sector. And what all these lead to is that the Chinese state is heavily involved in economic activities. This unique role of the state has created many distortions in the economy, and some of which are the root causes behind the many phenomena that we see on the surface, including the rapid buildup of debt. And while people tend to focus on what is happening on the surface, I think it's really important to recognize the structural forces behind the scenes. I'll just mention 2 most important distortions. One is the role of local governments in the economy, and this notion of local government land finance, which refers to this phenomenon that local governments rely heavily on the land they own to create additional revenue and raise debt to fill their fiscal gap. This is a root cause of the housing affordability crisis in China's largest cities, and also the rapid buildup of debt among developers as well as households. And the other major distortion in the economy is this notion of implicit state guarantee behind state-firm liabilities, which refers to this widely held belief in China that the governments will always bail out underperforming state companies rather than letting them fail. This is where the soft budget constraints and the lack of financial discipline of the state sector comes from. I think without addressing these structural problems, the many issues that we see on the surface, including that, will very much remain going forward. Tom's remark made me think that perhaps the really relevant question we should be asking is not whether the China bubble will pop. By the way, that is the title of Tom's latest book. Even if that bubble will never pop, it does not mean that the development model of China is good or efficient, or even something that other emerging economies should learn from. Like I said, the special role of the Chinese state in the economy has created many distortions. And the state is not only the rule maker in the sense that it writes the rule for everybody in the economy, the state itself is also a player on the ground and a very large player. And this is the essence of this entire development model. When the player role of the state is in trouble, the rule maker role of the state can probably help it out by writing new rules in favor of itself. And this may be viewed as an institutional advantage, but this is by no means fair to the other players, especially the private entities in the economy. And there's also the risk of overcorrection or overshooting, as we have seen repeatedly happen in the economy. So this current model can probably last and keep growing for a long time, but if China keeps telling itself that this model works perfectly fine, I think it would be missing an opportunity to make its economy even stronger, fairer, and healthier through some really serious structural reforms. The second point I'd like to make is about the banking system. I agree that if we look at the aggregate, the Chinese banking system seems to be doing okay. And one of the reasons, as Tom rightly pointed out, is that they have stable funding base, which is deposits on the liability side of their balance sheets. But I wanted to add a bit nuance here. There's great variation among Chinese banks in terms of how their balance sheets are structured. For smaller banks like city and rural commercial banks, including Baoshan, which collapsed in 2019, a significant portion of their funding comes from sources other than household deposits. Because they are small and regional, and given there are also restrictions imposed on how much deposit rates they can offer to their customers, they're in general less attractive and less capable of attracting deposits from retail customers compared with Big Five or other large joint stock banks. So they have to look for funding from somewhere else. Much may come from larger enterprise deposits, which tend to be less stable than small deposits from retail customers. And smaller banks also tend to borrow more from the central bank and borrow more from the interbank market. And then on the asset side of their balance sheets, which I don't think one can entirely ignore, oftentimes these smaller banks have close ties with local governments. They're often used to lend to local government financing vehicles. And smaller banks also tend to have more SME customers that are in general more risky. So these smaller banks are a source of risk that cannot be ignored in my view. That said, I agree that these may be individual risks, and it's unlikely to trigger a system-wide crisis given the unique political economy of China and the many tools the Chinese state has to manage crisis. I guess we can talk more about that if people are interested later in the discussion. The last point I wanted to make, which is more relevant to the present situation in China now, is very simple, which is while we should always keep an eye on signs of financial instability, otherwise now is not a good time to worry about that too much. As Tom showed in one of the slides in his presentation, China's macro leverage ratio actually dropped quite a bit last year, which was mostly driven by a drop in debt ratio of non-financial corporation sector. Well, it seems a good development that the debt ratio is dropping. It's actually quite worrying because what was behind the drop was that fewer businesses were borrowing and investing, so that the drop in debt ratio actually happened at the expense of deteriorating macroeconomic conditions, including shrinking demand and weakening expectations. And that is not the type of deleveraging that is really desirable. And given the Chinese economy is now slowing quite dramatically, largely because of the widespread lockdowns in the country under zero COVID, deleveraging is probably not something that China should prioritize now. I think the policy focus now should be to encourage businesses, especially private ones, to borrow and to invest in order to let the economy recover as soon as possible. And by doing that, it would also be supporting the recovery of companies' debt servicing capacity. Some Chinese economists are advocating publicly that we need to do whatever we can to save the Chinese economy now, and I very much agree. If doing that means the debt level will rise, that is probably fine for now. With that, I'll stop and hand over back to Nicola.
Your last statement, Qianlei, was quite provocative, advocating fiscal stimulus, if I heard it correctly, to sustain the economy and prevent a damaging downturn. So I'd like to have Tom's reaction on this, and then I have tons of questions, and we're also starting to get questions through the Q&A. Of course, please use the Q&A tool to ask questions. I will filter them for our panelists. Tom.
Sure. So I agree. China's industrial production shrank in April. China's retail sales shrank in April. China's property sales and investment are on a downward trajectory. This is absolutely a moment where China's policymakers have to think about the short term and put longer term concerns about deleveraging and rebalancing the economy a little bit further down the agenda. The binding constraint, of course, is not kind of policy space, although that is more constrained than it was 15 years ago. The binding constraint is COVID-0. Why hasn't China fired the starting gun on stimulus very loudly? Well, it's quite hard to stimulate an economy at the same time as you're requiring everyone to stay in their residential compound. Until they deal with COVID-0, they can cut interest rates as much as they like. They can give as many subsidies to consumers as they like, but it's not going to have the desired impact.
So we have questions actually on your, unsurprisingly, your chart with trajectories for the Chinese economy raised a little bit of attention, and both Sharmin Musaba Rahmani and Caroline Atkinson are asking about demographics and how the demography plays into the long-term position of China versus US. And also a question from Sharmin, this is a typical investor question, do you assign probabilities to the various scenarios on the slide?
So, so I mentioned Deng Xiaoping as a kind of hero of China's reforms. In one important respect, though, Deng Xiaoping is also the villain of China's growth story, because Deng Xiaoping, of course, introduced the one-child policy. And the one-child policy now means a significant demographic drag. The last time I looked at the numbers, I think I saw that China in the next decade is going to lose workers equivalent to the entire population of France. Now, as an English person, of course, and with apologies to Nicolas, if the entire population of France disappeared, I could see some positives as well as some negatives to that. Humor doesn't always go across well. But from a Chinese policy perspective, clearly saying goodbye to 50 million workers is a significant negative for the growth trajectory. What can they do to offset that? Well, they have some margins for maneuver around retirement age. Retirement age for both men and women in China is quite low. They can increase that. They have some margins for maneuver around hukou reform. If you get rid of the hukou, which ties people to their place of birth in terms of their access to social benefits, you can have rural workers participating in the urban labor market for a longer part of their life. And of course, China has also...
Sorry for interrupting. Hukou is a residence permit, right?
That's right. Yes. Yeah.
Okay.
And China also, of course, is also already made very substantial investments in education. So the people exiting the labor force now are the children of the early reform era or the late pre-reform era, limited education in many cases. The children entering the labor force now have had much better educational opportunities. So you're going to have less workers, but the human capital per worker, I think, is going to be higher. So there are some offsets, and of course, the Common Prosperity Agenda is also, in part, an attempt to turn around the demographic trajectory and make it easier for people to have more children, and so restore population growth. So there are some offsets in place. There are some more things they can do, but certainly, even with those offsets, even with those future steps, demographics is a drag going forwards.
Tianlei, do you want to comment on demographics?
Well, I want to say a few words about U.S.-China, their respective economic size. I think, the Chinese economy will almost certainly overtake the U.S. Tom has showed different scenarios And I think it's decided by the sheer size of the Chinese population. And China overtaking the US as the largest economy does not necessarily mean that China on a per capita basis will be richer. I mean, based on in TPP terms, per capita GDP of China is about 27% of that of the US now. On demographics, I very much agree with what Tom said. And aside from the solutions that Tom raised, there's also gender discrimination. I mean, China is one of the few countries globally where the labor force participation between women and men is actually widening, because a lot of the women are leaving the workforce, but largely because of all kinds of gender discrimination at workplace. So that's another area where China can also do something to help with its demographic trends. And also there's, well, Tom mentioned the quality of human capital. I think that's equally very important. I will not elaborate on that. I think Tom has put it very well, especially on how to improve the education of those living in rural China.
I'm surprised about that, Tom, maybe to pick up on what Tianlei just said. There have been, the book by John Rosell, I think, on the low quality of education in rural China. Jacob Kierkegaard at the Peterson Institute has published a couple of analyses on this. I felt you were very positive on education reform. So is that something you base also on the countryside analysis?
So Scott Rosell's book, Invisible China, is a really excellent book. And in a world where there's a number of kind of commentators kind of organizing the same kind of dreary set of publicly available facts into a different configuration to tell a different story about China, I find it really refreshing to read a book like that where someone's gone and done a bunch of really detailed research and pulled it together into a compelling new synthesis. And Rosell's book, for those who haven't read it, is grounded in detailed fieldwork in China's countryside. And what he finds is some worrying trends in terms of health, nutrition, and educational standards for China's rural children. So I don't dispute that, but China also has a very, very large number of children living in the cities. And we are also, what we're doing is we're not saying that we're not comparing China's rural children to some kind of abstract high standard. We're comparing China's overall educational standard now with the overall educational standard in the late 1970s and early 1980s, right? And on that comparison, I think even with many children in the villages, sadly, not getting the opportunities they need, the overall picture is still a significantly higher level of human capital.
So Sherman reminded us that you haven't answered her question about probabilities. So I feel a duty here. And also we have a question from David Wertheim on whether it's important. I mean, it's kind of a very general question, right? How important is it whether Chinese GDP surpasses US GDP or not in the future?
So let's take the probability one first. So I think as I indicated in the presentation, I don't think this is a moment to make definitive calls on this. There's huge uncertainty about COVID, huge uncertainty about real estate. That said, I would assign an almost zero probability to the optimistic China gets everything right line. I think the balance of probabilities is centered on the white line and the red line and the space in between them. So China is partially successful in executing on reforms, retains strong international ties, even with the some fraying, or China is substantially unsuccessful on reforms and faces substantial fraying in international ties. So I would, just making things up, put probably a 70% weight on those two lines and the space in between them, and the remaining probability I'd assign to the disaster scenarios of financial crisis or the kind of fun but difficult to kind of decide on with any degree of certainty possibility that China's just making up its GDP numbers.
I push you a little bit on the latter because here at the Peterson Institute, Nick Lardy has told us time and again that China's statistics had more information value, at least some of them, than many people realized. So you said it was plausible that the data were being cooked. I'm intrigued by the fact that based on your chart, the implication is that this is a recent phenomenon. So can you give us a little bit more about that?
Sure. So I want to give everyone an assurance that I'm a super fun guy, and if we had drinks, it would be great and you'd enjoy it. But I also want to tell you that my first book is called Understanding China's Economic Statistics. And the main conclusion— I
don't see a contradiction between those two propositions. There's something I miss.
I'm speaking to the right people, obviously. I actually agree substantially with Nick. I think there is a lot more information value in China's economic data than the kind of casually contemptuous view you often hear on Wall Street suggests. At the same time, I also think there are very, very legitimate concerns that especially the high profile numbers like GDP are being massaged for political purposes. Now, there's a kind of a parlor game amongst China analysts to kind of make up an alternative GDP series, right? And lots of people do that. We do that. Academics do that. Some of the investment banks on the street do that. The issue I have with all of those is that whilst they all have a degree of plausibility to them, they're all more or less arbitrary or made up, right? You pick your proxy, I pick my proxy, we have a debate about which proxy is better. Often both proxies come from the Chinese government itself, which raises the kind of slightly strange question of why you don't believe the GDP numbers, but you do believe electricity or rail freight or something else. Now, the number we have in that chart for the fake data series is also somewhat arbitrary, but what we did is we picked it from the literature. There's some academics at Hong Kong University and Chicago who did a big study, and I think it was grounded in local government tax data. And the conclusion they drew was that the GDP data was more or less fine until 2012, 13, 14. And then it's overstated by about 2 percentage points. So we just took those numbers.
Qianglei, you've worked a lot on those statistics. What's your take?
Well, first of all, I think it's all relative. Some sorts of data are more reliable than the other types. I mean, for example, trade data is generally believed to be more reliable than investment data. There's simply a lot of room for manipulation in terms of the quality of investment data. I'm sure Tom knows that very well. By the way, that book, Understanding China's Statistics, was one of the very first books I read when I started working on China.
Congratulations. That was an early misstep. Congratulations on correcting your trajectory afterwards.
Well, and the second point I wanted to make is that I think Chinese statistics in general are improving, even in investments. I mean, we noticed that in recent years, the statistical authorities have been trying to correct the investment data series by taking out a lot of double counting and other sources of bias. So data in general are improving, and most importantly, I think what is even more worrying than this possibility of data manipulation is that I think there is a lot of data are missing. The problem of lack of data, I think, is very pronounced now, and it's even more pronounced in recent years. Sometimes you find that all of a sudden they discontinued some series. For example, the data that Nick used in his latest book, State Strikes Back, on new lending to different corporates, of ownerships. That sort of discontinued a couple of years ago. And it was just looking at the social security coverage by migrant workforce, and that sort of discontinued in recent years as well. So I think that's the even more worrying trend than the data manipulation issue.
So we've managed to get to 40 minutes of discussion without mentioning the war in Ukraine, without mentioning the regulatory storm of last year, without mentioning Taiwan. I want to go into a couple of scenario questions that come from the audience primarily. So Haji Michael has this question of the rising security conflict between China and the US and the West in general, the risk of slower growth because of those risks and reduce trade and investment flow. So you refer to that in terms of China's isolation, but I guess here it's also about an escalation compared with the trends we observe. And we also have a question from Kathleen Stephenson on the probability of China invading Taiwan and the impact on financial stability. So maybe tail scenarios, but not as remote that we could ignore them. Similarly, Charmin is asking about an upside scenario of reform. Is there a higher probability of important reform, maybe beyond the Congress deadline of November? Kathleen Stephenson also asked whether there could be a kind of deus ex machina for the economy through a massive vaccination campaign. Do you see that coming? And last but not least, Martin Schroeswemper here at the Peterson Institute notes that, Tom, you're quite optimistic about stability, but there doesn't seem to be a floor in terms of the Chinese growth rate going forward, given zero COVID. So if zero COVID remains for an extended period of time, could we see the growth prospects going down and down, perhaps even into negative? Martin doesn't say that, but is there a bottom to that deterioration? So lots of questions here, but basically, threading the needle around those different scenarios, including more disruptive ones.
Okay, I think that's actually a fairly large number of needles to thread, but I'll do my best. US-China decoupling, I think from 2016 to 2020, it was kind of slightly possible to tell a story about this being an idiosyncrasy of the Trump administration, and perhaps there was going to be a return to normality under the Biden administration. I think the Biden administration has certainly restored the kind of procedural norms and reopened the diplomatic channels, but in terms of the structure of the relationship, I don't think it's got better, and indeed, I think it actually continues to get worse. The tariffs remain in place. There is a broad reconsideration of the US-China technology relationship underway, which I think is almost certainly going to end with reduced Chinese access to US universities and the technology from US firms. So I think the decoupling trajectory remains in place, and for China's future growth, that means less access to global export markets, and it means less access to global technology. And both of those things they're not going to be catastrophes for China, but I think they shade down our expectations about China's future growth path. On Taiwan, I'm not an international relations expert, but if I was sitting in Beijing and I was looking at how the world has reacted to Russia's invasion of Ukraine, I would probably think that the reaction from the Europeans and the US was bigger than I'd expected and more unified than I expected and more damaging for Russia than I expected. So if I was sitting in Beijing, I would probably start incorporating that in my calculus of what would happen if there was some kind of military intervention in Taiwan. Now, on vaccination, this brings us back to the question of how China exits in the end from COVID-0. And I think this is still an open question, and I think there is not a clean way of doing it, right? So whatever happens, China is going to have a messy period into 2023 as they either attempt to stick with COVID-0, which as we've seen in Shanghai and Shenzhen and Beijing and Jilin recently is like very costly, or transition to living with the virus. My view is that after the Party Congress, they will begin transitioning to living with the virus, and to do that, they will need to acquire a very, very large number of mRNA vaccines to minimize the public health cost as they attempt to make that transition. And on Martin's question on the floor in growth, also, hey, Martin, good to see you. I think that one of the interesting things which has come out of the COVID crisis is that China has learned that they can actually live, at least for a period, with very low or even negative growth, right? I mean, those of us who've been watching China for a pretty long time have this idea in our head that there is a kind of a Faustian pact between the Chinese Communist Party and the Chinese people. The Chinese Communist Party delivers growth, and the Chinese people, because their standard of living is continuing to rise, give up their claim to participation in the political process. I think what the Chinese Communist Party has learned during the COVID crisis is that actually they can go through periods of very low or even negative growth without that being a disaster for social stability. And so I wonder if that has led to a reappraisal in Beijing of what their growth bottom line is. Maybe before COVID, they thought their growth bottom line was 5, and now, just making it up, maybe they think it's 2.
Very interesting. Chanlei?
Well, on US-China decoupling, I think there's desire to decouple from both sides. The war in Ukraine has certainly prompted some rethinking among Chinese elites about how China should pursue some decoupling from the US in certain areas in order to reduce the risk exposures. Shall events happen across Taiwan Strait that will lead to similar sanctions being applied to China. And there is an ongoing discussion about the need to reduce China's exposure to the dollar. And some Chinese economists are calling for greater diversification of China's foreign reserve and saying China should hold less dollar assets. And relatedly, China also wants to step up efforts to build its own SWIFT alternative, which is SIPs, in case one day, like Russia, China may be also kicked out of the SWIFT messaging system. And there are probably other areas that China wants to decouple from the US as well. For example, maybe China also wants to do its own version of friendshoring along the BRI countries. On vaccination, I think it is going on. I mean, from what I have seen here in Shanghai, but I think the question is still about the low efficacy of the Chinese-made inactivated virus and China's hesitancy to approve foreign manufacturing mRNA vaccine, which are obviously more effective than the Chinese ones. On zero COVID, I'm quite pessimistic because, first of all, there is zero tolerance of debates around zero COVID, whether zero COVID is the best approach that serves the best interest of the country, right? And discussions and criticisms online have been censored, and experts' advice is being ignored. Well, if there's anything we have learned from the initial outbreaks of the Wuhan outbreak in 2020, it's that a healthy society should not have just one voice. So I'm quite pessimistic about the trajectory China will go under this kind of circumstances. And the implementation of zero COVID has come to an extreme that zero COVID has become the highest priority over everything else. And I agree in a sense that agree with many people who are saying this is more like a political campaign than a public health one. The lockdown here in Shanghai has led to the zero COVID here in Shanghai comes with very high human, social, and economic costs, and the draconian lockdown measures have led to many non-COVID related deaths that could have been avoided. And all of this, I think, is leading people to rethink this conventional wisdom about the Chinese state being flexible and pragmatic. Perhaps that is changing. And if you look at foreign investors' attitude, the impact on foreign investment is huge. Many foreign investors are in this process of reevaluating their presence in China triggered by the lockdown in Shanghai, and there is a possibility that the recent very negative outlook of the foreign business community may have some longer term implications. So it's perhaps not just some noise in the short term.
Right. There's one aspect on which Zheng Jian has a question, and I also was curious, which is innovation and more generally entrepreneurship in China. Well, there are two different things, but they're related. So Zheng Jian is asking about campaigns to promote domestic innovation, and is China making progress on that front, or are the constraints that we already discussed going to mean that they can never get to the point of technological autonomy, if I put it in the European language, as they seem to aspire to. But I have a slightly different question also on entrepreneurship and entrepreneurial vitality, because I'm surprised that we didn't discuss much the campaign against the private sector listed companies and a number of different industries last year, as if it had already been forgotten. But we had all these things against, online education, Alibaba and Tencent, and gaming services, etc. And I guess the larger question here is there any fear that this campaign is killing the entrepreneurship engine of China? That basically the message is, don't even think about getting rich through entrepreneurship in China, because ultimately the state will crush you? Or is that a vast overestimation of what has been happening, and basically the entrepreneurship engine of economic vitality that we've seen in the last decade is alive and well at this point? What do you think, Tom?
So two really big questions. So on innovation, you used to hear a story about how authoritarian China, with its rote learning education system, wasn't going to be able to produce innovative free thinkers. And you don't hear that story anymore, right? China has some of the most cited papers in some of the best journals on some of the most exciting topics in the frontier of technology. AI, for example. Companies like Tencent, like Alibaba, are demonstrably very innovative. US universities like having Chinese PhD students come over as their research assistants and future professors, because they're incredibly smart and have great ideas, right? So the sort of the basic idea that China can't innovate because they're authoritarian, I think that's wrong. The other point I would make here is that if we're thinking about the US-China economic race, as Tianlei mentioned, China's population is just much bigger than America's population. So China only needs to get to a much lower level of productivity per worker in order to be the biggest economy in the world. And that means that, in an important sense, China doesn't actually need to innovate in order to become the world's biggest economy. They just need to learn, right? They just need to absorb technology and ideas from other countries, and that will be enough to make them the biggest economy in the world, and so also the world's biggest geopolitical power. Now, on the entrepreneur question, and the common prosperity agenda and the cancelling of the Ant IPO and the crackdown on Tencent and Meituan and other big tech companies. So there's a kind of an easy narrative on this, which is that the Communist Party hates the private sector. Xi Jinping is very jealous of any potential rivals, and that's the entire explanation. Well, that could very well be part of it. But I also think it's possible to tell a story about that entire agenda, which is much more grounded in legitimate public policy concerns. China, like many other countries in the world, has a big problem with inequality. They have a big problem with the cost of living. That's contributing to their demographic problem. People don't want to have more children because they can't afford to buy an apartment for them. They can't afford to pay for their education. And China, with the sort of the rise of the giant tech companies, has a new problem with tech monopolies, similar to the problem that we're grappling with here in the United States and in Europe as well. And I think it's actually perfectly plausible to tell a story about the common prosperity agenda grounded in those concerns. It's an attempt, maybe it won't be successful, maybe it will, but it's an attempt to address the problems of inequality, of high cost of living, of the kind of grasping power of tech monopolies.
But if I can push you on this, isn't that in a way a risk as of itself, right? I mean, being slightly simplistic here, the question is, will China's trajectory be more like the US, which keeps innovating and finding new, ways to preserve and develop its economic vitality, or will it be more like Europe with, more social protection and fight against inequality, but at the end of the day, less entrepreneurial growth and less growth overall? So how would you look at that one, even assuming that the common prosperity is a kind of social democratic agenda of moderate state regulation and correcting the worst excesses of the private sector?
So I would square the circle by saying that because China is still in catch-up mode, because GDP per capita in China is still a third of the level in the United States, they can have both, right? They don't need to have entrepreneurial innovation in order to move up the development ladder. They just need to have copying, right? And for copying, you don't really need sort of very sharp kind of red in tooth and claw Anglo-Saxon capitalism. You can have a more statist model.
If young Chinese, or not so young, if Chinese is a more energetic, entrepreneurial, leaving aside technological innovation, if the most entrepreneurial people no longer can dream about being Jack Ma because they think that they will get crushed, doesn't have this necessarily a negative impact on future growth.
So I wonder how far we should take the narrative about sort of the crushing of the entrepreneurs, right? I think that the people who founded China's big technology companies are extremely successful, extremely rich, and still in control of their technology companies. So yes, the operating environment for them is significantly, I think, more constrained than it was 2 years ago before the common prosperity agenda kicked off. But I don't think there's been a comparable trend to, for example, what happened to the Russian oligarchs under Putin in the early 2000s.
Right, that's very interesting. Thank you for that. I pushed you a little bit, but I'm very interested by that debate. Chanlei, on all this.
Well, first on innovation, I just want to add a point that private sector obviously plays a very important role in innovation, but the Chinese industrial policy doesn't always succeed in pursuing private entrepreneurs, influence their investment decisions, telling them where to invest and what to invest in. So it's I think we shouldn't take it for granted that wherever the investment will go wherever the state wants them to go. On entrepreneurship, I think the impact on investment sentiment was hugely negative, at least last year, right? That was shown in the credit data, and the state obviously has realized that it went too far, and it's now trying to make course corrections. And I agree very much with Tom on the intent of the regulatory moves last year. I saw most of the regulatory moves the state has undertaken last year was relatively focused. And like Tom said, some of what they did had logical public policy justifications that was long overdue, for example, on antitrust. That said, I think we also need to acknowledge that this overall environment in which the private sector operates in today is just very different from 10 years ago, even 5 years ago, right? As the regulatory tightening of a range of industries show, the Chinese state is now setting guide rails for the expansion of private capital, and it is starting to draw boundaries. It has made clear that private capital is not allowed everywhere in the economy. For example, it doesn't want private capital in public services like education, and in some sectors where the government may feel sensitive or strategically important, even if they don't own the sector, the state may very much want to be in control. A very good example of this is the so-called special management share arrangement in certain tech and media companies, right, which gives minority state shareholders an outsized governance power. Though so far the implementation of the arrangement has been limited to only certain media and technology companies, and has not yet posed a challenge to this overarching one share, one vote principle, which is required in the Chinese legal regime.
Getting at the hour, so the last question I wanted to address, but very quickly, from Helen Lai on renminbi internationalization strategy, and more broadly, I mean, you mentioned the importance of the state-controlled financial system in preventing some risk scenarios, and especially financial instability. So this would be an entire session, but just in a few sentences, can you give us, Tom, your take on whether we may expect any financial reform, or whether the dream of renminbi internationalization will remain a dream? How do you think about that?
So it's a really big question. I think there was a moment at the start of Russia's invasion of Ukraine where the United States and Europe moved to seize Russia's foreign exchange reserves. And I think that we're going to look back and realize that was actually very...
Freeze, not seize.
Freeze. I think we're going to look back and realize that that was actually a very important moment for the international financial system. If you are China, if you are Saudi Arabia, if you are any country in the world which has a very, very large amount of assets being held in US dollars, I think that's a moment which is going to make you think to yourself, perhaps I need to start looking for alternatives. Now, at the same time, for China's yuan internationalization, there are some very significant headwinds, right? China is lined up on the wrong side of the conflict. This is not a moment where yuan internationalization is going to receive a kind of a welcome hearing in the United States or in Europe or in many of the global financial centers. This is a moment of heightened financial stress for China's banks. We've talked about the problems still coming for the real estate sector and all that means for financial stability. So it's also a moment where it doesn't make sense for China to push ahead with the kind of capital account liberalization, which is in important respects a precondition for the yuan to play an expanded global role. So I think the motive for them to push yuan internationalization has clearly been sharpened considerably, but the opportunity for them to do so, I think, is still significantly constrained.
Tianlei, any last word on this?
Well, I very much agree. I was about to say the same. I think even if China wants to internationalize its currency, how much demand there is globally would be a question.
On this, because we're already past the hour, unfortunately, we'll have to end there because this was a very rich conversation. I hope the audience will share my appreciation for our two panelists, and we covered a lot of ground. So, so thanks very much to Tom Orlik and Tianlei Huang. The next session will be on June 22. In a bit less than 2 weeks, we'll discuss Turkey, or Turkey as it wants to be called now, and whether it can continue defying financial gravity as it has done for a number of years. Thanks very much, Tom and Tianlei, and thanks to everybody for participating.
Thanks, Nicola. Thanks, Tianlei. All the best.
Thank you for having me.